Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go. Welcome everyone to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, Matthew Peck. A lot of our clients of SHP and the partners and all of the shipmates that here at our firm hold charitable giving and the idea of giving back extremely important. So what we wanted to do today was explore that whole world, the official world of charitable giving, not just sort of like, walking by the Salvation Army, Santa Claus who has the bell and you toss some coins in. No, we're talking about the industry of charitable giving and the tax planning that goes with that, the legacy planning that goes with that. And I think all of our clients and audience, here at SHP knows that we're continuing to provide as many services as possible, and especially to the higher net worth, where tax planning and charitable giving go hand in hand. Now, everyone, no matter where you are on the wealth spectrum, obviously charitable giving, and this is going to be for you, but when it combines tax efficiency and charitable giving, you sort of need a partner. You need someone that kind of understands that landscape. And so today is our first step down that journey. Now, looking forward to having sort of in-person events and different things along those lines. But today is our first step down that journey to understand how tax planning and charitable giving and how that industry all works together. Now, SHP is very proud of all the things that we do well, but we also know the limits of our knowledge, and we know we need to have a specialist in here. And so we're pleased today to have Kyle Casserino. Hopefully I get that right. He'll hit me across the head if not, and I'll say it a couple more times. But we have Kyle Casserino of Fidelity, who is a VP of Charitable Planning. And we're honored to have him on board because I know he's going to have a wealth of information for myself personally, as I understand it better, but also for all of our audience. So without much further ado, Kyle, thank you so much for coming on our show.
Oh, thanks, Matt, for having me. Really looking forward to it.
Yeah, so, and I know I talked to you offline, but first, I love always starting with background and kind of like how you got into charitable. Do you call it charitable giving, charitable planning? I guess I might stumble a little bit there, but just how did you get into the industry in the first place? And what changes have you seen in your time in charitable giving?
Mm-hmm. Well, yeah, it was sort of, I would say, it was the blend of both of my worlds at the time. So growing up, and even to this day, I did a lot of work with my church and went on various missions across the country. And that was always a huge part, philanthropy, in my day-to-day and my family's legacy is just the idea of, hey, we want to give back. We want to do it in the right way. And then in college, I was a finance major. And it's like you start to do the job search and you find, well, what's out there? And you do the classic financial advisory practices. But then it's brought to my attention this group at Fidelity. It was Fidelity Charitable, and it was basically when I started, it was kind of like a startup at Fidelity. We had 70 employees, 50,000 donors. It took us about 22 years to get there. So it was a really small operation within the bigger Fidelity ecosystem. And fast forward to today, and we've just grown tremendously. We're now at almost 800 employees. We work with almost 500,000 individual donors that use our program, and we're sitting on about $80 billion. So it's been crazy. And, you said about the change. It's like if my boss asked, obviously I was responsible for most of it.
Wow. Yeah, right. There you go. Yeah. Mark that down. But so it's almost, let's sort of start there, right? Like I know there's donor advised funds, and we'll be talking a little bit about donor advised a lot, actually, I'd say donor advised funds. But that really when did that, was it like a bill that was passed and that created donor advised funds, or was it more, no, let's create like a business entity? I guess, how did donor advised funds begin?
Yeah, it's funny because they haven't really become all that well known until the last maybe 5 or 10 years. But donor advice funds have been around for over 100 years now.
Oh, get out. Okay.
Yeah. So small community foundations used to do these back in the day. And then Fidelity got into the game in the early 90s when, at the time, Fidelity's chairman and CEO, Ned Johnson, says, hey, listen, we really want to democratize giving. Right? It's almost like the mutual fund aspect, right? For charitable giving, where it was like, hey, you don't really need to have $1 million to buy this basket of investments in a portfolio. You can do it with a small dollar amount in a mutual fund and still get the advantage of all that upside and the ability to diversify. Right. The same thing applies with charitable giving. The idea then was, hey, listen, like you needed $500,000 or $1 million, even at the community foundation level, or if you're going to do a private foundation to make it make sense. So the idea was, let's make this so that everybody in America that gives to charity can take advantage of it. And that's where we are today.
Okay. Well, yeah, and I should also take a step back. So, because I mentioned, or I launched right into donor advised funds, but let's back up a little bit. So, because I certainly want to talk about the different styles of charity and kind of where to give and how to give and the tax implications and all of that. But let's just start high level. Like, what are the vehicles that you work with, that Fidelity works with? Like, what is a donor advised fund? I mean, literally, let's start there. Or some of the other ones that we mentioned offline. What are the vehicles? How do they work? And let's really just take us through charitable giving 101, and then we'll start to build on it.
Yeah.
But please, if you don't mind, walk the audience through just the basic vehicles, how they work, etc.
Well, it's important, I think. Let's take a step back, too, before we even go into the vehicles, to just understand what giving in America is like.
Okay. I like it. Even this is great. 2 steps back to get 3 steps forward.
Exactly.
So I like it.
So folks would be so surprised to hear that the Giving USA report, they put out a report every year, and it basically measures the volume of giving in America. The last report had $557 billion going to charity.
Wow.
Okay, that's like 3% of the U.S. GDP, and that's in 1 year. $557 billion. Okay, it's a huge number. There's over 2 million nonprofits in the U.S. alone. Okay, so you have to think about how many people those employ, how many folks are giving, and a lot of it you think is probably like, oh, it must be these huge companies or these massive foundations that represent those numbers. Actually, 70% of that number is by individuals. 70%
of that number of giving?
Correct. Of that $557 billion, 70% of that is giving by individuals.
So, and not to bring up a tragedy as an example, but Kyle and the producer Evan and I were talking about how Kyle was living out in LA during the wildfires. And so just as an example of that, last year, but so you're telling me when that little ticker says, text here for American Red Cross and whatever that may be, 70% of that $500 billion is from people just seeing little tickers or whatever that may be, just individuals making gifts.
That's right. It's grandma and grandpa that are at home that send $50 to any charity that puts anything in the mail to them.
Yeah.
All the way from your Silicon Valley entrepreneurs and tech executives and C-suite levels that are giving 8 and 9 figures a year and everything in between.
Wow, on the individual level. And let me say, I do like the little return address stickers.
Not bad.
I still use them. I'm a charitable guy. We'll talk a little bit, but I get little stickers.
Right. It's the gift that keeps on giving, really.
Yeah, right. So here it is. So 70% of this, literally $500 billion, more than $500 billion are going towards charities. 2 million. I didn't realize that either. So there's 2 million individual charities out there. So it's an industry. Like when I said industry, I was just trying to think of a good word, but it really is like it's a business. Mm-hmm. Interesting. And obviously in the business of doing good. But
the business of doing good, that employs a lot of people. That's involved in a lot of people, right? There's folks that are helping and being helped, right? So it's a pretty cool, it's a great industry.
Yeah, and obviously talk about a win-win. So then, so here comes Ned Johnson in the early 90s. Even though these community funds and have been sort of around, he said, okay, let's democratize the system. Mm-hmm. So, let's, if you don't mind, or if we're ready for it, you tell me. I don't want to push the pace too much. But so then what is a donor advised fund?
Okay. So in the simplest sense, this is a charitable giving account, which basically helps people or companies separate the timing of their tax benefits with when they actually have to give the money to charity. Okay. So the tax benefits happen on the way into the donor advised fund. The assets inside grow tax-free outside of the donor's estate, and then they use the funds to give to their favorite charities just at their own pace in their own time.
Well, actually, yeah. So let's more do sort of a compare and contrast. Mm-hmm. So I'll say $50,000. And I'm going to give to a charity, right? Okay, what are my options? So Matt Peck podcast, SHP, partner, financial advisor, all that stuff. I have $50,000 that I want to give to a charity. What are my options? And kind of compare and contrast what I think most of our audience would think like, oh yeah, you just write a check to the American Red Cross.
Right.
But there are options.
There are options. And candidly, if that's the only gift you're making throughout the year, just give it to the charity directly.
Okay.
No problem, because you get the same tax benefits in the donor advised fund that you get when you fund a public charity.
Okay.
There's no difference. We're a 501c3, all donor advised funds are. Just like the Red Cross and the Salvation Army and your religious house of worship. No difference. Where it comes into play, I would say, is more about giving the right asset, though, at the right time. Okay? So a lot of people think, and charities have made this so easy, is to give cash. Right? You can go online, you can use your debit card, ACH it, credit card, you get the points, which is kind of cool.
Yeah.
Or you can, even like some charities now have PayPal and Venmo and ways that you can give to them all electronically, but it's all cash. This isn't a hot take, but cash is the worst asset you can give to charity. Why? You either have to earn it as income and pay income tax on it, or you have to sell an appreciated asset and pay capital gains. So that's what it costs somebody to give cash to charity. Most people that we work with are giving appreciated assets. And whether that's to a charity directly or through their donor advised fund, it really doesn't matter. But the IRS kind of incentivizes you to do it because think about it, you were going to give away $50,000, right? Let's say you bought Apple for $20K that's now worth $50, but you were going to write a $50,000 check to this charity. What you would do instead is you would give that Apple stock in kind to the organization. Why? You're going to get a $50,000 tax deduction, the current fair market value of the stock, and then you don't have to pay the capital gains tax on the growth. Okay, so it's a great way for people to sort of reset their basis in a lot of investments because think about what you just did. You're going to off this position that has huge growth in it, but you're going to give away $50,000 a year to charity. Put that $50,000 right back in your trust or your investment account and just buy back the shares the day after you gift them. Okay, because now you can still maintain that same $50,000 of exposure in Apple. So you're not going to miss out on the upside, but now you're just getting rid of that really low basis asset. And when you do want to sell Apple in 3 or 4 years, now you pay capital gains tax on today's value and that future value, not 5 years ago when you bought it in that future value.
Oh, interesting. Okay, and I certainly want to talk about that, about what to give, right? About the difference between cash and sort of appreciated stock. Because I'm also curious about whether or not there's appreciated property and other thoughts there, and also that even gets into IRAs and qualified QCDs, qualified charitable distributions. But let me also reel back too, because I think one of the things that always struck me about the donor advised funds versus regular charities and different things like that is something that you said that I really want our audiences to understand is that the donor advised fund is a charity just like any other charity, right? So whether it is a donor advised fund at Fidelity or whether it's American Red Cross or the Alzheimer's Association or the Boys and Girls Club, they're all individual charities. So whenever you gift money, and we'll talk about whether it's cash or appreciated stock in a second, but all of them you get a write-off as it goes in. And the write-off is obviously different for people, meaning that like I know there's like AGI levels and and how much you can write off, and we'll hopefully get to that because there's so much to talk about here. But here's a donor advised fund, and so it's like okay, I can either give to a donor advised fund, or I can give directly to the American Red Cross or Boys and Girls Club or whatever your charity of choice. But the big difference, and then correct me if I'm wrong, Kyle, but the big difference is that you get the write-off once it goes into the DAF, but then every year you can decide where the fund distributes the assets. Right. So it's like, let's say that 50,000, and I definitely, as I said, we will go back to whether to do appreciated stock or cash or whatever, because I think that what you said is extremely important, especially when it comes to appreciation. But okay, so it's almost like, okay, rather than giving it to the American Red Cross all at once, well, what happens if I want to give a little bit to the Red Cross one year and a little bit to Boys and Girls Club next year, so forth and so on? You can just fund the DAF with that $50,000 and then either give it to the American Red Cross a little bit, or you can divvy it out a little bit. I mean, just explain that a little bit, or just make sure I have all my stories straight in regards to how that works, and just the comparing and contrasting between just the charity directly versus a DAF.
Right. So what you described is totally right. We kind of talked about it before, but if you are a donor that gives to one charity every year and it's just a one-time gift, there's not really a great reason to use a donor advised fund. The donor advised fund is set up for the administrative efficiencies, right? It's the person that's giving to multiple charities a year or that's giving monthly. And then at tax time, they come to their CPA with a booklet like this. And then they say, or when they're doing all this administrative processes, they're looking at, like, did we pay with our credit card online? Did we write them a check? Did we have Matt send 20 shares of Apple to them? Did they send us a tax receipt in the mail? Did they email it to us? And it's this really administrative process. And what ends up happening, and I hear this from clients all the time, is that we gave $500 to our nephew's Relay for Life. We couldn't find the receipt, whatever.
Yeah.
Not a big deal. You're leaving money on the table as a result. So most people that use our donor advised fund are using it for the administrative efficiencies. And even if they're doing it so it's like, hey, I give out $50,000 a year to charity, I give to 3 or 4 different organizations, the benefit for somebody like that is, like, at tax time, they have one receipt to give to their CPA. Even if they've distributed that $50,000 to 1,000 different charities at $50 each.
Yeah, which is a great point. So rather than saying, like, okay, hey, I have $50,000 and I'm targeting the American Red Cross, it's more like DAFs are great for someone that says, I have a $50,000 budget. Right. So my budget or my annual giving is $50,000, right? And so rather than, as you said, like cutting checks and doing all this to 10 different organizations, I can just do $50,000 into a DAF, and then the donor advised fund. I keep on saying DAF, but DAF is donor advised fund. But I put $50,000 into the DAF, and then the DAF can cut out 10 checks, to those various charities, and I just have that one letter, that one write-off, that one, 1099 or whatever it is, or whatever form you get from Fidelity.
That's right.
Right.
And not that we would ever want to make your life easier, but that's the great part for the advisor too. It's like, okay, now you just have one charitable contribution to do, so it just record keeping wise so much easier, right? So that's not anymore of the game of where your clients are coming to you and saying, okay, here are the wire instructions, or here are the DTC instructions for this charity, and you have to coordinate with the charity to, okay, we're going to send 10 shares of Apple here. Did you get it? Can you send us the tax form back? All of that process is eliminated when you use donor advised funds,
which is fantastic, and that's really why I wanted to kind of spend some time there. So really, for any of our listeners, that if you do have that budget, right? If you do say, look, I give every year $25,000, or even, you mentioned missions. I mean, even if it's a tithe, I don't know if tithes play into it. I'll get your opinion on that. But more the idea that, okay, if there's this budget that you give every year, all right, you might want to consider just rolling it into a DAF, and then, just distributing the exact same way. It's not like the end charities don't suffer. They'll get it, and then administratively, it's just that much easier. Now, also, I also want to talk to another audience of people that you should consider DAF, and then Kyle, you can kind of again color this in a little bit. Is that okay? Number one priority are people that have set budgets that say, I'm going to give every year 50, 25 grand, whatever it is. So administratively, it helps. Because you get that big write-off that one year, it's also very helpful for people that may have a large capital gain, either through a sale of a business or a sale of a property, right? So in other words, like if someone says, like, oh my goodness, this year I won the lottery, I'll as a really more broad example, but oh my gosh, all this money is coming due this year, I'm going to have this massive tax bill. That's also something to consider when it comes to DAFs, correct?
Totally. I mean, we talk about the administrative profile of the people that use these accounts, but that's really the second is the one that's going through the massive life event. So many people use donor advised funds almost like a 401k these days, right? Because your tax benefits are so much better when your income is higher, right? So what folks will do is they'll say, listen, I'm nearing retirement, right? My last 5-6 high income earning years, what I'll do is I'll basically prepay my giving for my entire retirement, even maybe into the next generation during those high income years into the DAF. Right? So what you can do is you can contribute, whatever the number is, it's 100% deductible. And what those folks can do now is now you're going to take off income from the 37% bracket rather than when you're in the 22% bracket when you're retired, just getting your 401k income. Way better to do it when you're in a higher income tax bracket, right? The tax benefits are better. You're taking that money off your income that you give. So a lot of people will use this as an opportunity to say, hey, I sold my company this year. I exercised stock options. I've sold some real estate. This is a huge tax bill for me, and we'll talk about the right asset to do it with, but that's a great way to offset income in a year while basically prepaying your charitable giving for maybe 10 or 15 years, all the while you're getting that tax deduction right then and there.
Yes, and so I'll definitely talk about the whole idea of exactly how that works in regards to like prepaying, and then what do you mean prepaying over 10 years? And I know we're going to go there, but I just want to confirm or really clarify for our clients. I mean, yes, if you are, and whether it's a big life event, I love how you put that. So you sold your business, and suddenly you're about to get a $10 million one year, right? Now you're spiking your income that particular year, or you just have a high income earner, like, and you're up there, and you just say, okay, well, how do I sort of maximize my tax deductions now? After as I said, that sale of a business or a high income earner, you then fund the DAF with sort of like 10 to 15 years worth of sort of future future charitable distributions, all in that 1 year. Right. And it's like, okay, well, what do you mean I'm pre-funding it? Like, what do you mean when I'm pre-planning? I think I'm just I'm sending a DAF $1 million and I'm getting a write-off. What do you mean I'm prepaying?
Right, because you're going to use the DAF like a charitable wallet, right? So maybe your charitable giving never changes at all, but you're just using the DAF as the way to send the money out to the charities, right? So you're taking the tax deduction now when your income can justify a huge write-off, but you don't actually have to give the money to your favorite charities until whenever you're ready to do it. And keep in mind the assets inside the account are growing tax-free. So that 10 or 15-year plan could easily stretch to be 20, 25 years through investment growth.
Well, that's kind of what I'm glad you explained that, because that's really what I wanted to hammer that point home, was the fact that because I was explaining earlier about, okay, I could either give directly to the charities, or I could make it a much more administratively easy and much easier to manage by just putting a DAF and then having the DAF cut the check. But the DAF doesn't have to be emptied. It's not like that can be in perpetuity.
Totally.
So it could be for 5 years, 10 years, 15, and you can choose different different charities each year. And as you were saying, that money is invested, right? So that's really what I want to convey to the clients, and to our audience, and different things, is the fact that when it goes into the DAF, it's almost like your own private foundation.
Very similar.
Okay, because I remember one time, I think it was actually a colleague of yours was saying, like, you can either, like, sometimes clients would come to us, and I love it because they're like, look, very, very high net worth. I would love to start like a scholarship or a foundation or something along those lines. And I'm like, okay, well, I love the drive, and I love the desire to do something like that. But then when I looked into it, it's like, okay, you can either start your own foundation and have to do all the administrative work yourself, or you do a DAF. And the gentleman I was talking to at the time just said, like, okay, you can either start a bank or and all the work that goes into that, or just open up a bank account.
Right.
And that's kind of how he described the differences between trying to start your own private foundation and just establishing a DAF, which can go to perpetuity.
Right. And foundations are sometimes right for the right people, right? To your point, I mean, it is like running a charitable business. You have to work with an attorney to get a tax ID number, file articles of incorporation. That's on the low end, $5,000 or $10,000.
Okay.
The foundation has an annual tax filing, just like you would as an individual. Those are the kind of things that are in play administratively that people have to be aware of. So the barrier to entry of foundation is probably a little bit higher. Like, you're probably not going to start a foundation with those costs at $100,000. You probably need at least $1 or $2 million to make this worth it. A foundation makes sense for people that want to employ a staff, right? They want to hire family members or friends to do grant research. They want to travel the country and pay those expenses out of their foundation to go visit different charities, or even the world for that matter. They want to go to Africa and help with wildlife preservation at some of the safaris. Like, they can pay for that out of the foundation because it's related to the mission. All that kind of stuff doesn't happen in donor advised funds. The donor advised fund is specifically a grant making vehicle.
Yeah.
Right. So you want to start a scholarship fund. Let's just look at this. The context of doing this in a foundation or a donor advised fund. In a foundation, you can be the one that sponsors and creates a scholarship. So it could be like the Jane Smith Foundation is who's awarding the scholarship. If you do it through a donor advised fund, you have to partner with a charity, right? So you have to send it to the high school or the college, and then they'll be the ones. I mean, that donor can have their name on the scholarship and all of that, but in the donor advised fund context, there's some balances that they need to take in play too.
And as you said, they need to partner with sort of an established charity rather than establishing it personally. But that's interesting about the fact that so private foundations might be an option for certain folks because you said like the idea of like employing whether they're family members or whatever that may be, but I certainly I love the ease of work with the DAFs and the donor advised funds and the fact that you can do it in perpetuity, right? It's something that lives beyond the initial gift, and then that gift obviously you have to make distributions from it, but that gift can continue. You can add to it each year, and then just and then change charities as just the flexibility to change charities as you go,
right? Because
there are different needs. Obviously, I'll talk about the wildfires before, but there's always, sadly, well, let me put it this way. One of the things that I'm curious, so a little bit not off topic, but more of a broader question. It's like and this is one of the things I've always struggled with personally when it comes to the charitable world is like, there are so many good causes out there, you know what I mean? And like that's the reason why the donor advised funds always appeal to me personally, and especially when I talk to clients about them, is just the fact that you can change the end charity on a regular basis, and so it's like if you can't make that decision like me, right? I can't because Alzheimer's Association is wonderful and cancer research is. They're all amazing charities. The DAF was always appealing to me because you can choose different charities each and every year. You're not locked into one particular one, right. and it's something that can live forever, live for the rest of your lifetime. Correct?
Totally. It can go generation to generation, like a foundation does, and I think. It is important to talk about the differentiators too a little bit, like what foundations do versus the donor advised funds. So one of the big differentiators is the 5% distribution requirement. That has to happen out of foundations. It means that a foundation has to distribute 5% of its net assets every year to one or more qualified charities. There is no distribution requirement on donor advised funds.
Oh, I thought there was. I'm sorry, that's interesting. I thought there was like a small amount or like $50 or something like that.
Every 2 years, which is our internal policy. That's not donor advised funds as a whole.
Oh, interesting. Okay.
So, and it's kind of interesting. So, this is like a trivia thing for a lot of folks. Is guess how much foundations in America give out? Now, that they have to give out 5%. So, across all foundations in America, what do you think the average is?
Let's see, $50,000.
No, in terms of percentage.
So
they have to kick out the 5%.
You have to give out 5, maybe 3?
Okay. Well, they have to do the 5, so it's 5.7%.
I'm sorry. Take it back. Okay, so it's what over and above the 5?
Correct. So it's 5.7 is total.
I would have said like 8% then.
Right. So it's low. So our donors every year give out between 19.5% and 21.5% of our net assets.
Oh, interesting. Yeah.
Without any minimums.
Yeah.
So which always been like the rumblings of like what can be like the legislative updates with donor advised funds. There should be a payout requirement, but we argue that if you put a floor on it, you're going to see what's happened to foundations.
Yeah,
and you're going to see probably a decrease on the account level of giving because now people know they have to meet that and maybe like, we're not going to give this charity $100,000 this year because we know we have to do more next year.
Yeah.
So it may pull people back from that. So, and that's one of the big differentiators. The other thing too is that a private foundation is such a misnomer because it is anything but private. Okay, so if you have access to a computer, you can pull up the last 5 years worth of tax returns of any foundation out there. That's Bill and Melinda Gates, your favorite celebrity, your neighbor down the street. You can see the assets in there. You can see who they're giving to, who they employ, how much they're granting out, everything. It is, and you don't need to be an accountant to do it either. It's so easy to decipher.
Yeah.
So it's anything but private. So anybody, like I said, anybody with access to a computer can see that information. So donor advised funds, we have a tax filing every year, but it's an aggregate of all of our donors.
Yeah.
So we'll never be able to see, like somebody can go onto our site and pull up our 990 and say, oh, Fidelity Charitable gave $25 million to the Red Cross, but they have no way of knowing donor by donor who did that.
Yeah, who actually did that. That's interesting. So it's actually more private than, you could argue it's more private than a private foundation would be.
Right. Well, we have a lot of donors. Actually, this is like a pretty interesting case is that I was working with a family last year who their daughter went to, I won't even bring up the college, but they were going to college and they were in a particular school in the college, and one of the professors knows that the family gives big money to the school every year. Okay, so the professor comes up to that person, the child in the class, and said, separately, but says, hey, listen, like we'd really love your family to direct some of these funds towards us or towards our particular initiative what we're working on. So weird, right?
Yeah.
So now that family, what they do is they say, listen, we don't want any charities knowing who we're giving to, because charities use the foundation tax returns as a solicitation tool. Like if you're giving to the Boys and Girls Club in town, why would the YMCA not contact you?
Yeah, right. Absolutely. Yeah,
right?
They'd be like, hey, wait a second. Hey,
yeah,
we're serving similar ends.
Totally. So what they do is they just say, okay, I'll make a grant to my Fidelity Charitable Donor Advised Fund. On the foundation's tax filing, it just shows as one grant to Fidelity Charitable. We're a 501c3.
Yeah.
So if you're looking at their tax filing, you just see one grant to Fidelity Charitable, then they do all their giving out of their DAF anonymously every year.
Oh, interesting. Yeah, so almost like ends up being a combination of the two at that point, depending. Totally. Interesting. All right, so Kyle, before we get too far down the path, I want to go back to the cash versus the appreciated stock.
Totally.
Okay, so because I want to make sure. So now, all right, so now, audience, here we go. Right, so now we know we can either gift to charities directly, but it's a little bit easier to manage, via DAF. We could do a private foundation, which again works for certain folks and certainly has some benefits there in regards to making it a family affair. But a little bit more public than you may have expected. But what's nice is, again, we're still getting all these tax write-offs, and I'll spend a little bit of time on taxes afterwards. But we know our options, right? Mm-hmm. Private foundation, DAF, maybe directly to the charities, things along those lines. But then let's talk about what to give. Now, I was giving a way too simple of an example of just saying, okay, I've got $50,000 in cash, and where do I give it? But really, it ends up being more of like, okay, yes, I have cash, but I have appreciated stock. I mean, what can you give, right? And then what's the best item to gift?
Yeah. So when you look at your balance sheet, the asset that you'd love to give to charity is one that has the highest percentage growth in it. Okay. Because that asset at the time of a sale is the most what you're going to pay in capital gains taxes on.
Okay.
Right? So long term, held for 1 year or plus. So it has to be at least held for that period of time. But the ones that have the highest percentage growth in the portfolio are the best to give, right? Because those are the ones that if you sell them, you're going to get crushed in taxes on. Like we have a lot of folks that come to us that have these concentrated positions. It's like I've held Disney since the 80s, bought Tesla early on, or NVIDIA is most common. It's like, okay, now all of a sudden I'm up 1,000%. Now my portfolio is so overweight, or now I'm like way too exposed in this one asset. So those are what people usually fund their charitable giving with. Okay,
so just to pause there. So now obviously if you are a business owner and that sold their business and suddenly has this big windfall of $10 million, that's in cash paid out to you, et cetera, that's a different story. We'll talk about that. But for most folks who did not have this big windfall or big life event, they would then look at their after-tax accounts, look at their brokerage accounts and say, okay, if I do have that budget of $25,000 or $50,000 a year in charitable gifting, now I'm looking at the appreciated stocks.
Totally. Because I think the other thing too is that it's a lifestyle thing too, right? Because when you're giving cash to charity, that's coming out of your checking or your savings account, right? So it's like that's part of a donor's budget. So if they're giving the right asset at the right time, they may not even have to factor it into their lifestyle. Right? They're not having to dip in their own pocket to give to charity. They either already have the money set aside in the donor advised fund, or can use some of these pre-tax assets to do it with.
Well, and that's what I wanted to make sure that we were clear on too, is the fact that, okay, so now let's say I look at my after-tax accounts rather than raiding my cash. Because I loved how you said something that I'm going to build to now was that, okay, so I want to give $25,000. So now I'm looking at NVIDIA. Okay, I can gift the NVIDIA, and now I have gotten the tax write-off
on the current value.
On the current value, like the appreciated value, and I didn't have to pay any of those capital gains.
Correct.
Let's say I bought it for $1 and now it's worth $25,000. I mean, that whole thing is appreciated. So I did not pay any capital gains, and I got a full write-off on the full value on the donation.
Totally. And then in the donor advised fund, it's sold tax-free. So now you have $25,000 in your example to give to your favorite charities, either right then and there or over time.
Okay. And then, but also let's just say what you said earlier is that, let's just say you really, really like NVIDIA stock. You can then, rather than using, you use the stock to fund the charity, but then if you have the cash that you were thinking about it, you can then take that cash and buy back that stock.
Right.
Yeah.
Buy back the stock. You're going to give the cash anyway.
Yeah.
You might as well give the right asset at the right time. Don't give the cash and use the cash, put it right back in your portfolio. There's no wash sale rules. You're not selling the video. You're gifting it.
Yeah.
Right? So you can just reset your basis. Now you still have the $25,000 of exposure in NVIDIA, but you've effectively stepped up your basis. Right? So now when you do want to sell it next year and you're like, market's not so good anymore. It's not what I thought. now you're going to pay capital gains on today's value and that future value, not when you bought it 5 years ago.
Oh, interesting. Oh, that's fantastic. Yeah, that's the thing. But these are all the things. These are all the different tools and strategies that just is so important to know, no matter where you are on, as I said, on the wealth spectrum, but also certainly on the high net worth, the higher income, the higher tax bracket that you're in. The higher you go up tax brackets, the more and more this becomes important for all of our clients to know, as well as all of our audience to know. All right, so we really unpacked like the DAFs of the world and different things along those lines. Something that you talked about before, and it was similar to what I was mentioning earlier about the cause. Mm-hmm. How much does Fidelity and yourself, Kyle, like help out people decide who to give to? Because sometimes, as I said, I struggle with it too. But then people say, "Oh, well, there's ways of measuring charities, based on like their dollar efficiency or something." Maybe there's a better term for it, but
right.
Is that something? Or I guess what guidance do you give people in regards to where to give?
So we're facing donors at a really interesting intersection, right? Because a lot of times people are coming to us when they've had those huge life events, and they're like, I've sold my company, but historically over the years, I've only really given to my religious house of worship or my alma mater. Mm-hmm. Right, and I've kind of kept it at that because we haven't really been giving much. But then we just sold our company for $50 million. Our account said we should give away $5 million before we sold it, and now we have this $5 million bucket to give away, but we haven't really figured out. We don't know what we want to do. Mm-hmm. So there are a lot. Like I'll kind of go from like the most simple to more complex. So in the most simple sense, there's platforms out there like Charity Navigator and GuideStar.
Okay.
They're great services. You get it for free if you're a Fidelity charitable donor, and what it will do is provide a rating system on a charity. Okay, to your point, expense ratios. If I give $1 to this charity, how much of it's being used for the overhead versus the actual purpose or the programs of the charity, things like that. They'll show you their analytics. They'll show you things like their mission, the programs they work on. So it's really comprehensive. That's the most simple sense. It allows people to do that themselves. Or you'll see like Center for Disaster Philanthropy is another great group. They'll do pre-vetted lists of organizations. So we talked about the California wildfires, like Ukraine, the Hurricane Helene in the Southeast. Mm-hmm. These are all kind of things where it's like, unfortunately, these bad things happen, and then you go online and it's like, okay, the first 10 charities that you Google are either fraud or they're horrible expense ratios, like they're not really using the funds right. So there's organizations out there that will put together lists of charities that meet certain criteria. Yeah, and
just real quick, that's something I know it happens, and I still can't believe it happens. That's all. I know there's a lot of bad actors and scammers and con artists out there, but I still can't. That's one of the things I can't fathom. There's many things on there, but that's one of them. Like, wait a second. Before I forget, because I do want to get back to the sort of how to rank them. But you mentioned about your house of worship and tithes, mm-hmm. And I brought up tithes earlier because obviously we have a lot of faith-based clients. So does that work? I thought churches weren't 501(c)(3)s, or how does that? Is that they are charitable donations, or what type of, when it comes to religious orders, what impact does that have?
So it's interesting because, to your point, they're not really 501(c)(3)s, but they're able to be given to from a donor advised fund or out of pocket and still get tax benefits for it. Okay. Here's the qualifications that they need in order to get out of the donor advised fund. They need to have a physical location, mm-hmm. and they need to hold at least one service a week.
Okay.
But we're giving to tens of thousands of religious houses of worship. As a matter of fact, the charity that we give the most money to every year, no free marketing, but is a religious house of worship.
Okay. So do people, when they talk about tithes and the 10%, is that something that sort of works into donor advised funds, or people still no, they'll kind of do that on a personal level with their church?
No, they do it out of their donor advised fund. Okay. Most people will, because keep in mind, the donor advised fund's already set aside for charitable giving. So if you have one, you might as well spend it. Right? You can always add to the account. You can't take money out of it, mm-hmm. Personally.
Yeah.
So it's, to your point, always people are doing that, especially when you're getting closer to retirement and you're like, okay, maybe I have to give 10% of my income this year to my church, but I'm going to put in like 2 or 3 years worth of my tithing so I can get the tax deduction now, but then basically prepay it.
Well, and that's the other thing that kind of popped in my mind is the fact that, so not only is it in regards to, because we talk about income tax and lowering your income tax with these charitable charitable donations.
Yes.
We talked about, obviously, if you have a big life event, but these funds are also out of your estate. So when it comes to estate tax, again, high net worth clients that are over and above whether it's the Massachusetts threshold, which is $4 million with good trust planning, obviously less without it. I know the federal exemption's higher, but just Kyle, a little bit, tell our audience about the estate planning and how it also factors into that.
Yeah, to your point, I mean, you're getting these assets outside of your estate when you gift them to a donor advised fund or to a charity, and candidly, most people have a charity or a cause area they'd rather see the money go to than Uncle Sam, right? So Like, if you're over the exemption, it's kind of like, okay, you pick your battle, right? Especially I always look at it like the IRA account, which is kind of a tough asset now to leave to the next generation, especially if the kids are successful.
Right.
You got to take the money out in 10 years, take the income hit, right? Not a great asset to leave to charity though, right? So if you're philanthropically minded, you want to get those assets out of your estate, maybe you do the qualified charitable distribution years leading up to it, but great to name a charitable beneficiary, one or more, or their donor advised fund as the beneficiary. That way you get them out of your estate when you've passed away.
Oh, okay. So you can name, I knew that you could name charities as beneficiaries, but you could name your own, I'll call it the Peck family, donor advised fund.
Yeah.
That could be the beneficiary of my IRA or 401k.
Yeah. And so many people do
it
now because they do their estate plan decades before they die.
Yeah.
Right. So it's like you want to lock yourself with your trust and estate attorney into one or two charities when you're in your 50s, but maybe you've retired and now you join a board, or now you're more religious, or now you're like, and then you have to go back to your attorney and say, listen, we want to amend the appendix. Let's put this charity in. Let's take this one out. Let's change the percentage of this one. It's like, that's expensive, to go do that. So most people, what they'll do is they'll say, okay, I'm just going to open a donor advised fund. I don't actually even have to fund it during my lifetime. But what I'll do is I'll name that as the sole charitable beneficiary of my estate.
Yeah.
The donor advised fund's a 501c3, and then you create the succession plan inside the donor advised fund that you can update online as much as you want, just like an IRA account.
Yeah. Oh, man. Oh my goodness. All right. We are running short on time, and it's only because Kyle, like literally, we could spend all day here, which is great because you just mentioned QCDs, and I'm almost like, oh my gosh, now we have to talk about IRAs and qualified charitable distributions in that world, and even like we were talking a little bit offline. So what I'm going to do is I'm going to tease our next episode. I'm not sure when it's going to be, but I would love for you to come back.
Yeah.
Because I mean, we didn't talk about qualified charitable distributions, which is IRAs, and how do you manage that, not just from beneficiary form like we just talked about, but also in regards to required minimum distributions and how they interact with those, and also some of the other, I wouldn't call maybe original tools, but tools that people might be aware of, which are CRATs, charitable remainder annuity trusts. You mentioned there was a charitable, what's a
lead trust?
So CLT,
right?
Charitable lead trust. There's a CRUT, charitable remainder unit trust. And so there's all these other vehicles and options, and they all sort of interact with taxes. I mean, because we were talking about really just like the nuts and bolts with how DAFs work and getting the appreciation off. But I mean, there's a whole other world and other vehicles, because we did have a chance to talk about the private foundations. But as I said, I'd love to drill down into the IRA world and the options there, as well as more of the legal world and some of the legal. And so again, comparing, contrasting there, understanding more about the DAFs themselves. Because I had another thought. Actually, yeah, this one's a quick one. So, all right, I set up a DAF, and then, my wife and I pass away. Who runs? What happens to the DAF after me and my wife pass away?
So you tell us during your lifetime what happens.
Okay.
So none of these are mutually exclusive, but there's really three routes you can go. Naming individuals. A lot of people do the next generation. Kids, just like a foundation, kids take over the account, can give to their favorite charities.
Okay.
So it's like a family legacy.
Yep.
Right?
Okay.
Where it goes generation to generation, the kids can pass it to their next generation, and all outside of the estate, keep in mind. So this isn't part of your trust or anything like that. It's just the successor. They open their own account or continue the existing one. That's option one, very vanilla.
It just pause there. If let's say the child has a DAF, can DAFs be merged?
Yeah.
Okay.
Happens
all right.
a lot.
Okay. All right. Keep on going.
Yeah.
Okay.
Option two is nonprofit. So this is great for the person that's got 10 or 15 charities listed as the beneficiary of their IRA. All those charities, I don't know how it is at other custodians, but at Fidelity, all those charities have to open accounts, IRA, BDA accounts at Fidelity. All 15 of those organizations have to open accounts before a single penny leaves that original IRA account, because they need to make all the successor distributions. Right. So charities that are the Red Cross, maybe they don't have a problem filling out the forms, stuff like that. But what about that religious house of worship that has a 10-hour-a-week part-time accounting staff who is like, we don't really know what to do here. Yeah. And maybe it's, maybe we're filling this out right, maybe it's wrong. It's a lot of back and forth. So most people will name charities outright, and those are great for people that don't have kids either, where they're just like, hey, we want all these assets to go to charities, but rather than locking ourselves into one or two, we'll just name the donor advised fund, and then all the charities can be paid out.
Okay.
It also works too, I think, like those combination of those two work really well for the people that are like, we really want our kids to give to charity, but we really can't force that next generation to give to the same charities their parents did.
Right.
So some people will say, I really want these charities, ones that I've given to, regardless of what our kids do, I want them to get something out of this.
Yeah.
So they'll make an allocation.
Interesting.
The third route, which I think is really helpful for people, and this is mostly for the person that's got the $5 million IRA coming into the account, where they say, listen, I don't really want to give a lump sum to one charity right away. I'd rather give them almost like an income stream for years and years after I die. So that person who maybe passed away this year, their names are still on the check in 2050 when those funds are still getting paid out.
Oh, cool.
Cool for things like scholarships.
Yeah.
Right? Like, why give the charity $5 million right now to fund a scholarship for the next however many years when you can give them $50,000 a year where they can line item that every year?
Right. Oh, fantastic! That's what I'm saying, Kyle. Okay, so that's why we are going to have you back, obviously, if you don't mind putting up with me. And sometimes like, wait, 5% on your endowment, or is it 8? Shoot, I got that one wrong. So as long as you don't mind putting up with us, because like I would love to have you come back and literally kind of build on this, right? Because we covered basics, but there's so much more. There's so many different options. How he works into like the tax planning, the legacy planning. Just your overall, like the overall impact you want to have, like,
right.
As all of us humans. I mean, I love talking to clients about that, because especially when they do get to sort of comfort, financial independence, if you will. And now it's no longer about, oh, hey, what stock do we want to invest, and hey, how much do you want to spend, and how are we going to close the income gap? It's like, what does significance mean to you? Right. And what does success mean to you? And what does impact mean to you? And that's why it naturally brings in conversations like charitable giving, obviously tax planning, legacy planning, things along those lines. And so, today's podcast is right up the alley for what we do every single day. And that's why we're hoping to have you come back. I know that there's plans to have you speak in person, which would be great.
Yeah.
And certainly, we're very, very grateful for, the partnership with Fidelity. SHP has its own donor advised fund. Matthew Peck and the Peck family has our own one as well. And again, just because it so aligns with not only our purpose and our own mission and passion here, but for all the charities and all the end people that benefit from this type of giving. Mm-hmm. So it's just, as you were saying, either online or offer online. I forget. It's just a win-win in so many different ways.
Totally.
Okay.
Yeah. Thanks for having me.
Yeah, I really, really appreciate it, Kyle. So stay tuned. You'll be more. You'll hear more from Kyle Casserino as we go. But again, thank you, Fidelity. Thank you for Kyle Casserino, VP of Charitable Planning. And stay tuned. You'll be hearing us again.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.